Hello, today I'd like to talk about dividend policy. Dividends are cash payouts to equity holders that reduce the equity of the firm, and they're one of three ways that investors can receive returns to their equity. Shareholders could receive dividends, or shareholders could receive cash from the firm that is repurchasing its own shares. So typically, dividend policy encompasses both the payout of dividends and the firm repurchasing its own shares. Equity holders, of course, can sell their shares in the secondary market to other investors. And there's a third way of payout of returns to equity. Managers can appropriate operating expenditures. If we have a private company with concentrated owner-manager shareholding, then this kind of appropriation can be efficient. Particularly, it can be tax efficient, although not necessarily legal, for the owner of the corporation to move his personal expenses into the company, thereby achieving tax deductibility. Owner-managers that take perks in a company, moving personal expenses into the company where there are minority shareholders, are violating their fiduciary responsibility to the minority shareholders, because directors owe the responsibility to all of the shareholders to look after their interests. This appropriating of operating expenditures, the ability to appropriate operating expenditures, is also in the hands of controlling managers whether or not they own stock. This is an agency conflict where managers can enjoy perks from the firm for private enjoyment at the expense of the owners of the firm. Our discussion today will be restricted to dividend policy and how that affects the wealth of the owners of the firm. There are two effects of a dividend payout. It gives shareholders an immediate return that they must accept. This is a cash payout, and it reduces the cash that the firm has available for other uses. You can see the effect with the managerial balance sheet. Here I've flipped the asset side upside down, so I show cash at the bottom, working capital requirement, and fixed assets at the top. And the cash payout to investors reduces by an equal amount the cash and the equity claims of equity investors. This reduction of cash tends to reduce future expected returns to shareholders. If this cash is useful within the firm, then that reduction of cash would reduce expected future returns to shareholders by share appreciation through reinvestment of that cash. If equity that is paid out in dividends is replaced by new capital, then the old shareholders' returns from that growth will be diluted by the new shareholders' claims. These cancelling effects give rise to the Miller-Modigliani dividend policy irrelevance proposition. The two effects of dividend payout will cancel if the investment policy of the firm is independent of the financing. So what the firm does in order to select appropriate investments has nothing to do with the financing. If the investment policy of the firm yields the cost of capital, so if every one of those investments are NPV 0, neither positive nor negative, if the new capital can be raised to replace dividends paid out so that the company can enter equity markets and can place its shares to new investors, replacing the funds that are paid out to existing equity holders. If that raising of new equity involves no issuance costs, so if there's no investment banks that have to be paid in order to issue those new shares, and if the new investors do not have to be attracted at a higher cost of equity capital than than existing equity shareholders require. If there's no investor tax differences from obtaining returns to dividends and capital gains, so there's no tax policies that would give investors a preference for receiving future capital gains versus receiving present dividends. So if these rather restricted conditions apply, then the effects cancel. The effect of immediate payout with the effect of dilution. If the effects cancel, then dividend announcements by the board of directors of a firm that it was going to pay dividends in this period and what those dividend amounts would be, those dividend announcements would not change share price. And on dividend payout, the share value would drop by exactly the amount of the dividend payout. To be more precise, there are 4 important dates in the dividend process. The dividend announcement date is the date when the board of directors announces that there's going to be a dividend payment of a given amount as of a given record date that will be paid out on a given payment date. The ex-dividend date is the first day on which the shares purchased in the secondary market no longer are entitled to the dividends. The record date is the date on which the shareholders of record are entitled to the dividends. Usually the record date is 2 days after the ex-dividend date, and the payment date is the date on which payment instructions are actually sent to the bank and the subsequent payment goes to the shareholders. So we have the announcement date, the ex-dividend date, the record date, and the payment date, where the difference between the ex and the record date in Hong Kong and in the United States is 2 days. So according to the dividend irrelevance proposition, if the y-axis is the price of the shares, we have 4 dates where the stock price may be affected: announcement, ex, record, and payment. If no other information is in the market except for the dividend information, the announcement should cause no change in the stock price. On the X date, the shares should drop in price, the value of the dividend. On the record date, there should be no change, and on the dividend payout date, there should be no change. So this would be the path associated with the dividend irrelevance proposition, where the difference between the initial price and the final price is the dividend payout per share. The dividend policy irrelevance proposition forms a highly useful theoretical starting point for the analyst. If a firm needs capital for investment, then the cash that the firm pays out to existing equity holders has to be replaced by new cash raised by issuing new capital to new equity holders. Raising new equity capital from new equity holders will dilute the claims of the existing equity holders. This highlights the need to justify costly dividends. What do I mean by costly dividends? Well, obviously issuing new capital does involve issuance costs, and it may be subject to underpricing to attract buyers. This means that the new issuance of equity is actually expensive. Moreover, taxation of dividends to investors may further increase the cost of dividends. In both US and China, both dividends and capital gains are taxed, but the capital gains of taxation can be deferred. In Hong Kong, neither dividend nor capital gains are taxed, and so these tax considerations do not enter into the picture. A major practical issue that challenges the irrelevance proposition is that a firm's investment opportunities are not separate from its financing. A firm's future is often dependent on discrete and unique investment opportunities. If it doesn't have the cash to take advantage of those opportunities when they arise, that may adversely impact the firm's future, and it may reduce the firm's value. Management insiders of a firm usually have better information about the firm's prospects than the market, and on a different note, management can destroy value through agency costs. Management can appropriate cash in the perks that I referred to before, thereby reducing the value of the firm. So dividends can be seen by the market as a predictor of earnings. A regular dividend is seen by investors as an undertaking to shareholders to continue to make payment of at least that current dividend per share in the future. Management in dividend-paying companies strive for constant, stable dividends in order to reduce share price volatility. Share price volatility increases the risk associated with share ownership, so this decreased volatility decreases the cost of equity to the firm and increases the value to equity holders. When a stable dividend is interpreted by equity holders as a performance prediction, a change in the dividend rate is often followed by a change in the market share price. Turning to the agency costs issues, dividends are payouts of free cash, reducing the potential for agency conflicts. Management may undertake projects to increase assets under management control, because by doing so, regardless of the profitability of projects, they can increase expected prestige and perks. If investors suspect that these agency costs are substantial, they'll view dividends as a current payout of 100 cents on the dollar, rather than a risk of investment to achieve a future payout expected to yield less than 100 cents on the dollar in present value terms. The informational and potential agency cost effects mean that what we observe in terms of the price reaction to dividend announcements is not what the irrelevance proposition predicts. If there is an increase in dividends that is announced, if there is a dividend increase, the market reacts positively to the dividend increase. Then there is the reduction of the stock price by the dividend amount at the X date and no further change at the record and payment date. However, if there is a dividend decrease, the announcement of a dividend decrease leads to a drop in the share price on the announcement date, followed by another drop by the amount of the dividend on the X date, and then continuing unaffected at the record and the payment date. Because dividends are such an important part of corporate finance, they've been subject to much empirical investigation. In a famous 2003 article in the Journal of Financial Economics, Fama and French discuss the disappearing dividends. Dividend payers within U.S. companies are decreasing, and they've decreased substantially from about 2/3 of companies in 1978 to only 1/5 of companies in 1999. Although since the financial crisis that number has increased slightly, there are still far fewer dividend payers in today's listed companies in the United States than there were back in the 1970s. One has to ask the question, why? Amihud and Lee, in their 2006 paper in the Journal of Finance and Quantitative Analysis, suggest a reason for the disappearing dividends. On the day of dividend announcement, increased dividends used to lead to higher share price increases in the past than they do now. They document that increased dividend announcements led to average share price increases of 1.5% on the day in the 1970s, but only 0.5% in 2000. They show that announcement of decreased dividends led to share price drops of 6% in the 1970s and yet only 2% recently. Moreover, these changes were inversely related to the proportion of institutional ownership of the shares. That means that when retail investors hold larger portions of the share, the retail investors react more to dividend payout announcements than do institutional owners. Institutional investors are more capable of analyzing industry and firm characteristics, and so are less reliant on the dividend as a signal of future corporate performance. To further clarify the dividend irrelevance proposition, I want to go through an example that's in your text, Ross, page 598, that shows the equivalence of dividend payout versus share repurchase. So here we have the pre-payout company, cash of $300,000, other assets of $700,000 for a total of $1 million assets that is totally equity financed. And the earnings of the company are $49,000. Shares outstanding are 100,000, giving an EPS of 49 cents per share and a market price of $10 per share, assuming that market price is equal to the book price. That gives a price-earnings ratio of 20.41. Now let's look at a dividend where all of the cash is paid out. That corresponds to a cash payout of $3 per share. Since there's 100,000 shares outstanding, that's a $300,000 dividend payout. The post-dividend earnings per share is exactly the same as the pre-dividend earnings per share. The post-dividend price, however, is the pre-dividend price of $10 a share minus the dividend payout of $3 per share, or $7 a share, which is also equal to the total equity divided by the shares outstanding, which has not changed. That gives a post-dividend PE ratio of 14.29, which is the reduced post-dividend market price divided by post-dividend EPS. Now let's look at the share repurchase. We will repurchase an amount to reduce our cash balance to zero, that same $300,000. Since the shares are worth $10 each, we have to repurchase 30,000 shares. That gives a post-repurchase number of shares outstanding of the 100,000 shares minus 30,000, and gives a post-dividend EPS of 70 cents. Note the post-dividend EPS is much higher than the pre-dividend EPS because there are fewer shares that those earnings are being compared with. However, the post-dividend price remains the same because there are $700,000 in equity divided by the $70,000 post-repurchase shares outstanding. So that leaves the PE ratio following post-share buyback at 14.29, the same as the PE ratio of the dividend case. Note that the shareholders have the same value whether you use a dividend payout or a share repurchase. The dividend payout leaves all shareholders with $3 of cash and $7 of share value. The share repurchase leaves the exiting shareholders with $10 of cash and the remaining shareholders with $10 of shares. So all that's changed between the share repurchase and the dividend payout is the number of shares outstanding and the earnings per share. But in terms of the PE ratio, the value of the firm relative to its earnings stream, that has remained constant. So you can see that buybacks have the same effect as dividend payouts if the shares are repurchased at their fair value. However, if shares are underpriced, clearly wealth will be transferred from the selling shareholders to the retaining shareholders. Buybacks need board approval and may need shareholder approval, but once approved, management may or may not implement the buybacks. A dividend, however, once announced by the board, must proceed. So a dividend announcement is a much clearer signal to shareholders than is a share repurchase announcement. Large buybacks need to be tender offers that are made to all shareholders at the fixed price, typically a premium to the open market price. And the reason why is that large buybacks effectively change the ownership structure of the firm. Open market purchases are the most common method of share buyback, but they can only be implemented for smaller amounts. A recent study from INSEAD by 3 professors, Marconi, Payer, and Vermeulen, look at market reaction to open purchase announcements around the world. And I've just summarized some of the data from that study, looking at China, Hong Kong, the US, and the rest of the world outside of the US. Open market purchase programs of both China and Hong Kong average 9.9% of shares. Now this corresponds to the maximum percentage that regulators allow Hong Kong and China listed companies to repurchase. In the United States and globally, the averaged announced repurchased amounts are 9.2 and 7.7% of outstanding shares. The percent completed within the first year of the program ranges from 20% up to 75%, and the percentage completed at the end of 4 years in the repurchase programs range from 42% to 92% of the percentage target repurchase amount. Open market repurchase announcements lead to excess returns around the announcement date. The researchers used an event window of -2 days to +2 days. Reaction to the open market purchase announcements range from 0.22% in Hong Kong up to 3.28% in China. So throughout, there is a significant and positive reaction to open market purchase announcements around the world. Investors will tend to buy the stocks of companies whose dividend policies suit their tastes. In different jurisdictions, dividends and capital gains are subject to different taxation rates, and different investors within these different jurisdictions are subject to different levels of taxation, and some are tax exempt. And some investors, as a part of their cash flow needs, require dividend payments, where other investors may be restricted by their articles of association only to buy shares that provide dividends. So one will expect that there will be investor clientele effects, especially in cases where the investors are identifiable by the members of the board, or where they actually appoint members of the board. These clientele effects might have strong influence on the corporate dividend policy of a company. Companies may follow a residual dividend policy. Residual dividend policies are often driven by the constraint that a company wishes not to issue new equity because of the negative effect that it would have on the company's stock price, and because of the dilution that it would give to existing shareholders. Managers decide the capital structure of the firm, then they decide the investments that are to be made, then they raise or repay debt to achieve the desired capital structure, and then they pay out the excess cash. In these cases, dividends or share repurchases use up the excess cash generated over the cash needs of the firm. Companies may also follow a stable and growing dividend policy. In this case, management sets the dividend at such a level so that excess cash is not accumulating too much, and so the firm is not likely to lower its dividends in future. A stable dividend, as we've mentioned before, is a signal to the market that management is confident in their predictions of future corporate returns. Management may combine a stable policy on one hand with payment of extraordinary dividends and share buybacks when cash accumulates. Note that companies that distribute cash through buybacks are typically dividend paying, and that they are using the buyback as an extraordinary distribution of cash. Clearly, dividends are part of financial strategy. You'll remember in our discussion of EVA during the last lecture that dividends figured prominently in the reaction to the interplay between value creation and cash generation. If the firm is generating cash and creating value, then it looks to creating more shareholder value through identifying new investments. And if it cannot do so, it should increase dividends and repurchase shares. If the firm is generating cash but is destroying the value, then it should not book additional projects, but should simply distribute cash through dividends or share repurchases. And if the firm is creating value and is in cash deficit, then it should cut the dividends and raise new funds through equity. This financial strategy matrix emphasizes that dividends are not irrelevant. Dividend and share repurchases are extremely relevant to finance, paying cash to shareholders. If markets were informationally and operationally efficient, if there were no tax considerations, and if managers faced no agency conflicts, then a firm's dividend policy would be irrelevant to shareholder wealth. As these three conditions do not generally apply, however, not only dividends, but also dividend policy are important parts of financial policy.